So, a big thank you to every one of you who has just joined us as we get started this evening on this session on passive income and investments that would enable us to do passive income. So I am truly honored to have you all here, and I believe that in the next few minutes we are going to learn one or two things. I don't come here as an expert. I come as somebody who has something to share, and I also believe that there is lots of knowledge with all of you who are here, and therefore I know you'll have a part to contribute in the whole conversation. So once again, I am honored that you would find the time to be here with us for the session this evening, and therefore let me ask Steve to just make a brief prayer for us as we get started, and allow people to, as we continue to allow people to come in. So Stephen Jalenga, you can make a prayer for us.
For giving me that opportunity. Let's pray. Father, in Jesus' name, we come before thy presence this evening. We want to thank you for the gift of life. We want to thank you for the gift of good health. We want to thank you, Lord, even for giving us the opportunity to be here and listen to these pieces of advice. How I pray that each and every word that will be said in this meeting will be a blessing to us. And as we finish up the meeting, O King of Glory, we pray that we'll live here when we have been blessed and we have been anointed with new knowledge. We pray for the speaker, anoint him and give him wisdom to speak to us things that are acceptable both to us and to thee, O King of Glory. I ask this short prayer in the name of our Lord Jesus Christ, our Savior.
Amen. 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 Thank you very much. Thank you very much. Thank you very much, Steve, for leading us in prayer. And without wasting much time, I would like to get into my discussion for today. Like I said, you will allow me to do this and run through it, and then maybe towards the end we can have a few minutes to just have a discussion. If somebody has a question, if somebody has a contribution to make, we'll be able to do that and then wrap it up for the night. So when we talk about asset classes, one thing that needs to be clear to us all is that investment is a diverse matter, meaning that there are hundreds, if not thousands, of approaches that somebody can take when it comes to investment. I hope you can see my screen. You can see what I am sharing on my screen.
Yes, we can.
Great. When you talk about asset classes, we are looking at the different avenues and angles through which somebody can approach the journey of investment. And what I want to start with is actually a quote from Warren Buffett. And Warren Buffett says, this is what I shared in the morning: if you don't find a way to make money while you sleep, you will work until you die. And that's a very profound statement, according to me, that there is a lot that rides on your ability to find a way to move your income, or the sources of your income, from what requires you to be active and present to a state where you're able to make money whether you're present or not. Takes me back to the conversation in these books by Robert Kiyosaki, Rich Dad, Poor Dad, and the Cash Flow Quadrant, where he talks about people being on the one side of the quadrant, that is the employment side, and the small business or the self-employed person, and requiring to be there, to be present, in order for anything to run, in order for anything to happen. So, and what you realize with this is that when you are operating from the aspect or the perspective of the employee or the self-employed person or the small business person, most of your income is coming from active sources, meaning on the day you're not able to wake up to go to work, you make zero money. But people on the B and I side of the contract, of the quadrant, that is the business and investment side of this quadrant, do not have to be there physically. They do not have to be there presently active in their business in order for them to make money. If it's a business person, they have created a system that generates income on its own without necessarily needing their presence. Of course, there's a lot of work that goes on behind the scenes before this person gets to that point. If it's an investment, this is somebody who has decided to put their money where it will be able to generate more without them necessarily needing to move a hand or be very actively involved in what is happening. So what do I mean when I talk about asset classes? Asset classes are different assets with different characteristics for different people. We are as different as our and as unique as our DNA. What works for one person doesn't work for another. What works for one person will not work for another person. So what needs to happen is for you to get to understand who you are and what works for you, so that as you move, you're moving in a manner that will favor you, and it will favor that which you are trying to do. So you choose what asset class to invest in depending on your needs and your risk appetite. So you need to ask yourself, what am I trying to achieve? What am I trying to accomplish from going into this investment? When you understand that, you'll be able to make a decision on what asset class to consider and what asset class to pass. The other thing you also look at is your risk appetite. There are people who are risk averse, so they don't want to hear that there is a possibility they will lose their money. So if you come from that school of thought, then there are assets you will want to focus on, and there are others that you'll want to avoid. There are others who are risk takers. So these are people who are willing to risk it all that will dictate the kind of places you choose to put your money. So there is no one size fits all approach. There is no way I can define or say that everyone needs to be in this space or everyone needs to be doing this in order for them to be succeeding in their investment journey. You have to look at yourself as an individual and decide what really works for me. So having said that, allow me to briefly walk us through some of the asset classes that I consider to have either a great degree of passiveness, or if it's not completely passive, it will not involve you on a day-to-day basis. Most of what I will share are things you've heard of before or things you've interacted with before, but maybe I'll say one or two things that might sound new to you. Either way, we are learning. Either way, we are getting to know what options and opportunities we have. So the first one that I want to look at are bonds. The best way to describe a bond is a loan either to a government or to a corporation, a company. And what bonds do is they make you money by the interest which they generate. Most bonds will pay you an interest twice a year. The percentage might differ from one bond to another. I know there are people who are here who can actually say a lot about bonds and even go deeper than I can. The other thing about bonds is that they also are good for preserving your capital, that for as long as you keep it and hold it, you'll be able to pull it out when all is said and done. There are different kinds of bonds, including treasury bonds, municipal bonds. Those are issued to governments, mostly the national government. In Kenya, I think the only county that I've seen doing a bond is the county government of Laikipia. The former governor, I think, was able to issue a bond successfully. So maybe in Kenya we have not yet gotten to the point where we are doing these municipal bonds to a large extent, but I'm sure that as county governments put their houses in order and begin to explore these options and think about how to raise funds for development, that these bonds will become a thing even at the county government level. When you hear people talking about the Eurobond, it's still the same thing, only that this is money that is being borrowed externally. So there is what the government borrows locally, and then there is what the government borrows externally. All of them are bonds. And the same way that people in Europe can buy bonds, can loan the government of Kenya money, you too can actually loan a government somewhere out there money. What matters is that you have the money and you've done your research and you know that this is secure. These, I would say, are some of the most secure investments you can go into, because no government wants to default on its obligations to its lenders, because governments depend on bonds, government depend on public money to be able to run affairs. Corporate bonds are loans extended to corporations. So there is a business in place somewhere that requires money to finance its operations or expansion or whatever, and they do not want to give up ownership. So they don't want to go the IPO way. They don't want to become a public company. So they can opt to borrow money from the public through a bond. If you have done your research well and you know that this is a solid company with a solid business and they can give me a return for what I am doing, then a corporate bond would work for you. More often than not, the returns are handsome, upwards of 20-25% per annum, but the risk is also equally huge when it comes to corporate bonds, because a corporation is not like a government. If the governance of the corporation is suspect, you're likely to experience things you cannot explain. So it's important that you know which company is this that I'm willing to lend my money to and expect that they will give me a return. So what are some of the pros and cons of bonds? So number one, on the positive side, with bonds you receive income through interest payments. So there is a regularity of income, because if they are doing an interest every 6 months, you're going to expect it to come through without fail for the duration of the bond. Whether the bond is 30 years or 20 years or 15 years or as short as 5 years, the interest payments will come through. The overall observation is that bonds pay out lower returns than stocks in the long run. That's a conversation for people who are not who are risk averse. Who are not afraid of risks. The people who are afraid of risks will go for bonds irrespective of what happens. But those who are not afraid and they are willing to dip their hand into the murky waters of the securities market, the securities exchange, then it's good to note that sometimes bonds will pay out lower because of the low risk. The low return also comes in automatically. Secondly, on the pros, when you hold your bond to maturity, you're able to get all your principal back. So that's why I said at the end of the period, you're able to get back your cash. So there is the aspect of capital preservation. You've lent the money, it's been used for the duration it's been used as you earn interest, but then you're able to get it back when the duration is done. A thing that you can also think about is when we talk about corporate bonds, government bonds will not really have issues with default, but corporate bonds companies can default on your bonds, because if their operations are not moving along, then it will be difficult for them to meet their obligation towards you. So that's why I said when it comes to a corporate bond, you need to think critically about whether you want to do it or you want to go slow, because if you're not sure about where you are investing that money, then it's wise to hold off until you do better research. You can sell a bond. This is an advantage. You can sell a bond at a profit. This is what happens. Initially, the bond is issued centrally, probably by the central bank or by intermediaries appointed by the central bank. But then there comes a time when they are opened up to the whole market. And anybody can buy or sell. So these are resellers and all that, and therefore you can put a markup on that bond that you're selling later. So it means you can cash out on your bond before its maturity. So let's say you bought a 30-year bond, but somewhere at 10 years you feel like I want to release this money and do something better. You can look for someone to buy at that higher price, so they continue to earn the interest, and you pull out your principal. The other downside for bonds is that bond yields can fall, meaning there is no guarantee that it will maintain the same percentage throughout. So you need to beware of that as you do whatever it is you're doing. So much for bonds. Let's look at another category of stocks and shares. This is not 100% passive. Let me put that disclaimer. This is not 100% passive. The reason why I say that is you do not want to trade in stocks and shares and be completely hands off. Why? Because a lot happens and a lot goes on in companies that you need your eyes open if you're choosing to invest in them. So, but what happens with the stocks is that you buy part of the ownership of a company. So, like everyone who owns Safaricom shares, for example, or Equity Bank or KCB, they have a fraction of the ownership of the company. There are different kinds of stocks, including what you would call common and preferred stocks. Common stocks are the ordinary stocks that are traded publicly. Preferred stocks are a separate category. And what happens is, in the event that a company is going under, the people who are on preferred stocks will be among the first people to be compensated before we get to the common stock. So it's good to understand that even as you think about it. You can look at stocks from a growth perspective. There are companies whose stock you buy because you believe that their valuation will go up in time. Mostly tech companies. For a lot of the stock in tech companies is in that category of growth. You can look at stocks from an income perspective, where for you are thinking about the dividends that you will earn. And you can also buy what are called blue chip stocks. These are companies with a solid history, a solid background, sound business practices. You know, these are companies that do not need to prove themselves to anyone anymore. Mostly utility companies, the KPLCs and the like, will fall under this kind of thing. So what are some of the pros and cons of stocks? With stocks, one, on the upside is you have the potential to build massive wealth. Anybody who remembers the Safaricom IPO, the shares were sold at 5 shillings a piece, and for a long time it looked like nothing was going to change. But as we speak currently, it's on the higher side of 25 shillings. So anybody who bought and has held on to that stock over the years has actually made gotten returns through the dividend, however paltry it might look like, but they have grown their wealth massively. Because I'm imagining, if you bought 100,000 shares all the way back at 5 shillings, that is about 500k. Right now you're talking about 2.53 million, just like that, because of the growth, without you needing to move a finger. You don't know what goes on at Safaricom on a daily basis, but hey, there is money. The other thing is there's a lot of variety. The NSE, for example, has hundreds of stocks that you can buy. Number 3, with stocks you can start small. You don't have to be wealthy, like much money, in order for you to be able to start, because think about a stock going for even 100 shillings. If you need to buy 100 shares, which is mostly the minimum, that's just about 10,000 shillings, and you are started on that journey. So it is possible for you to start easy. Then the issue of liquidity. If you get to a point that you feel like, I want to dispose these shares, it's a matter of talking to your broker or whoever is dealing with you, and they are able to find a buyer for you very quickly. So it's not a tedious process to liquidate your stocks. What are the downsides? 1, there are no guaranteed returns. So there is no assurance that the money you have put in will come back. At this point, I start to think about the KQs of this world and the Mumias Sugars of this world. Anybody who invested in them when they were on the up is feeling it right now, because we don't know how long and when really it's going to recover, if ever. Number 2 is it can take time to grow. You see, the Safaricom IPO was in 2008. It's been close to 15 years for us to get to where it is right now. So stocks are not a game for the short term. There are people who do what is called day trading. I don't envy them, but I can't do that myself, because I don't think I have the patience to watch and look at things on a daily basis. But yeah, stocks take time to grow. Market volatility. The value of your stock can swing left and right, depending on what is happening within the company and even outside the company. Something can happen from outside and it affects what is happening inside. Then there is also the potential to lose it all. Just the same way there is potential to build massive wealth, there is potential to also lose it all. If the operations of the business go south, if something is introduced into the market that is a challenge to what is the core business of this company, then yes, you are likely to experience a downward trend. So is there a better way of doing stocks? This is where I bring in the aspect of index funds. So with index funds, what you're doing is you are not investing in one company, but you're investing in a multiplicity of companies. You've heard about the NSE 20 share index, the NSE 25 share index, the NSE all share index. Those are some of the examples where what you're doing is you're trying to you are investing in a manner that matches the overall performance of the companies within that index. So you are trying to play the same game that the market is playing. So when it goes high, you go high with it. When it drops, you drop with it. This makes this investment low risk and good for the budding investor. In fact, if you talk to many seasoned investors, they say 90% of people need to finish their investment journey when it comes to shares with index funds and mutual funds. Why? Because the intricacies involved in studying a singular share in order for you to invest in it are not something that many of us have. Therefore, if you are in a position to get to understand index funds, then it's the best way for you to actually approach the securities market. It's very passive, because for you what you do is you buy into the index, and you can do something that in the West they call dollar cost averaging, where you set aside a particular amount of money every month that is going into this investment. So irrespective of what is happening in the market, for you, if you've decided I'm going to be setting aside 10,000 every month, that is exactly what you do. So what happens on the inside, what decisions are made on the inside, are none of your business. For you, at the end of it all, what you're waiting for is your dividend and the return and the growth that is likely to come as a result of this. Again, this is not a game for what would I call them? This is not a game for speculators. This is something that you get into because you want to do it long term, and over time you'll be able to see the gain. So what are some of the pros and cons of index funds? The upside is low management costs, because you're basically trying to match what the market is doing. So there is not a lot that is spent in terms of research and all that, fund management. There is the cost for managing the fund is relatively lower compared to somebody who is trying to beat the market. It requires little financial knowledge for you to invest, so you are not struggling to know the depths of finance. Convenience, so the bulk of the work is with the person who is doing it all, which is the whatever institution it is that is offering that index fund. The availability of diversification, the fact that you're investing in a range of companies, means that you have spread your risk significantly, so that if one is failing and another one is working out well, they are able to balance each other out, as opposed to selecting a Mumias sugar and it goes to 0 point something shillings per share. Recovering from that can take you forever, as we can see, because the conversation does not look like Mumias is coming up anytime soon. What are the downsides? There is lack of downside protection, meaning that if the fund starts dropping, because yes, it can also go south, there is no cushion, there is no cutoff at the bottom where you're saying, we'll never go below this point. It can go all the way down. Number two is you have no choice in the components that make up the fund. You buy into the fund with all that is in it, the good and the bad. So you dive in wholeheartedly. The third thing is you can't beat the market, because remember, the index is trying to match what the market is doing and what is happening in the market. I seem to be taking a bit long, so let me move on to the next one quickly. You've heard about probably you've heard about real estate investment trusts. In short, they are called REITs. Or real estate itself. A REIT is a company that owns, operates, and or finances real estate. So a REIT is a way for you to own real estate fractionally, without necessarily having to go through the hassle of building and setting up something for yourself as an individual. That in as much as I do not have money to build an apartment myself, I can put my money into a pool where there are many other investors, and this company builds and operates the real estate whether that is an apartment or a hotel or a hospital, whatever it is. They build and operate it, and for me, what I do is I expect to be paid at the end of either every month or at the end of every quarter, for subject to the amount of my investment in the whole project. So there are more. There are REITs that focus on equity, that is capital. Then there are REITs that are used to finance mortgages, and then there are hybrids which combine the two of them. When it comes to real estate just itself, we can talk about industrial real estate, where somebody can set up go downs, as we see a lot on the is it the eastern or the northern bypass towards Ruai and the like. There is a lot of industrial real estate that is coming up there. It can be commercial, where somebody is setting up office space, and it can be residential. The challenge with this kind of real estate is that it requires a significant capital outlay. So you go into that if you have the muscle to do it. Otherwise, somebody should be able to start with the REITs before you think about the other dimension. So what are some of the pros and cons of REITs? One, on the upside, is that REITs are easy to buy and sell in public. So there are public companies like Fahari that sell REITs at the NSC. You can have a look at them. The other advantage is there is stable cash flow, because for you, once you've invested, your payments are coming in periodically as agreed. The income is dividend based, so they are looking at what you've put in, and that is what pays you. If you feel like pulling it out, it is easy for you to liquidate. You just ask for your money back. What are the downsides? There is not much in terms of capital appreciation. So when you come to pull out your money, you'll pull out just what you put in. So the thing that will have helped you is the dividends that you have earned over the period. Then of course it has taxation aspects. I don't know the details about the taxation, but I know that that income is taxable. Then the management and transaction fees can also be exorbitant, and it is also subject to market risks. So whatever is happening in the overall market, definitely a real estate market will definitely touch on your investment. You can't run away from it. What happens for in the case of real estate? One, there is a steady cash inflow once that apartment is built or done. For as long as it is occupied, definitely the money is rolling in. The other advantage is appreciation in value. People who bought Membly 2015, 10 years ago, today the property that is there is in a totally different league. Many people bought it when it was 300,000, 400,000. Right now, we are talking about 8 million and above over a span of 10, 15, 20 years. It's also said that real estate is a hedge against inflation. It can protect you against inflation, courtesy of this aspect of appreciating in value over time. And then there is the aspect of income growth, because if you've put up apartments and there is need for you to increase rent, you can increase your rent and make more. The aspect of control also comes into play. What we mean by control is that this is an investment that is entirely within your control, within your hands. Nobody can challenge you or take you. Nobody else is in charge of what you're doing at the end of the day. What are the cons? Real estate is a slow grind. If you go into it expecting to make your returns quickly, you're going to be disappointed. You need to have a long-term view of things, so which is something some of us struggle with. There's the aspect of variable income. Variable income comes because if the occupancy is not 100%, then of course it will reflect in the income. But if you are in a place which you selected well and the people are there, then you're going to like it. You're going to enjoy the whole experience. They require maintenance. A big challenge. We will spend a lot of money putting up property, but then we run it down by failing to maintain, and that hurts us in the long run in terms of income. So you need maintenance. Then you'll meet the rent tribunal people and rent controls, people who want to put a cap on how much you can charge in terms of rent, depending on where you are. It is not fully passive, of course, because you need to pay attention to your property. And liquidity can be a bit of a challenge. It's very taxing to sell an apartment that you've already put up, unless it is in a very prime area and everybody has been eyeing it. It's not very easy to liquidate. That's something that we need to take note of. Then next I go on to equipment rentals. I'm rushing through this because I can see the time is really moving pretty fast. Equipment rentals, the same way people pay monthly for houses, people can actually pay monthly for an asset, like a car. There's you can think about specialized vehicles, like earth movers and graders. You can also think about just buying a vehicle and putting it into a car rental. There is one of us here, I hope he's still on the call, who does car rentals, Anthony Davids. He does car rentals. So there's room for somebody to invest in things of that nature. Machinery that is used to maybe in production in certain industries, you can actually own that machinery and rent it out, lease it out monthly. Of course, one of the challenges of that kind of business or that kind of investment is that it is subject to gluts. Kenyans are fond of doing what we call copypreneurship. So they realize that this is where the money is and everybody goes and buys the same thing. And therefore the market that you used to enjoy now becomes crowded. So what you need to do is look for a niche area. Like find an area which it is not very easy for everyone to go into, and serve it well and exclusively, and definitely you'll do well for yourself. This is an interesting one. Content. Did you know that content can be an investment? What do I mean? You've heard about royalties. People are paid royalties for their works, books, music, films, documentaries, photos. This could be done by yourself if you have the gift and the ability and the skill. There are people who are paid for taking photos, and those photos are not paid for once, they are paid for consistently. Every time somebody uses the photo, this person is paid. But you could also be there and you're saying, I'm not artistic, I don't have the skill to do this. You can actually also invest in the talent of someone else. You can invest in an author, you can invest in a musician, you can invest in an actor. This is done a lot by people out there. You've heard people saying, this artist is signed by this label. Basically what is happening is that these people are investing in the art, in the potential and the talent of this person, but they actually end up making more money even than this person. Because you see, when I sign you up, I buy the rights to your productions, and therefore for you I just pay you. I pay you according to the contract that we have signed, but I'm also making money off the whole thing. So don't sit there and say, because I'm not talented, I cannot invest in content. You can invest in content for other people and make money off it. It requires a lot of groundwork, of course, so it is not entirely passive at the start. But you see, once a book is done, it is done. Once a song is done, it is done. Once a film is done, it is done. And that is where the passive aspect comes in. Once a documentary is done, it is done. It doesn't matter how many times it is sold and resold and reshared and re-aired and all that. All these other times you'll be making money passively. There are certain very successful programs that have been sold and resold, aired and re-aired and all that, and every time it is happening, the original people who did the work actually receive payment, yet they did it probably 30 years ago. A good example, I think, is this show that people like. It's called Friends. I don't know how many times it's been done and how many times the rights have been sold to different people, but people continue to make money of it even today, having acted all those years ago. So it requires initial groundwork, but once it's done, you're good to go. So it pays for a lifetime or more, meaning that you can pass on your rights to the next generation, and it is also scalable. This is where we're talking about the reselling and re-airing and selling the rights to different media platforms and all that. So you can make a lot. I hope somebody is learning something as we go along. This is an old one, but also very interesting, and this, I say, is a must for everyone, that beyond what your employer is doing to prepare for your retirement, you actually need to do something for yourself. And the magic of pension plans is in the area of compound interest. It's some mathematics that I really love doing. Probably I will not be able to go into the details of it right now, but this is huge for everyone who is listening. And if you are not able to take action on any of the other things, please make sure that beyond your employer's pension plan, you are doing something for yourself in order to plan for the future, because our life expectancy is going up, and you had better make sure that as you live long, you have enough to take care of you. I want to go into private equity and venture capital. You've seen shows like The Lion's Den. You've seen the Shark Tank. Yeah, I think it's the Shark Tank. You've seen the Dragon's Den and things like that. Those people are actually doing what we call private equity. and some of them are doing venture capital. There's a slight difference between the two. Venture capital is for startups, people who are at the startup stage. You can invest in companies that are just starting up, so you become one of the early adopters, early investors, and you grow with the company. But private equity is about mature companies who could be in distress or could be seeking to expand their operations, but again they do not want to go into the securities market for that. They don't want to go public, so but they are looking for somebody who can invest in them. So you can become one of these people. You can become one of these investors and buy into a company. So what you're doing in this case is you're buying equity, you're buying ownership in this company, and you're able to make your profit as the company grows and as it expands in the direction that we are looking at. So the best way to do this is to join existing investors who have the expertise at this kind of thing. You don't want to go in alone at first, because you might not understand what you need to look at in order for you to make money. The potential for growth is high. These are people who are likely to make their money over and over and over again. This is really like going into a business, only that you are not going to do the day-to-day running of the business. You're going to offer your insight. So it is semi-passive. It is not completely passive. This is semi-passive because you're going to be there in a way, but you're not going to be like the CEO running things on a day-to-day basis. The next thing I want to mention very quickly is franchises. Franchises. Somebody can buy into a franchise, and there are franchises all around us. When you actually concentrate, you love eating at KFC, Subway, Pizza Inn, to name a few. Every time vitu gani sasa? Semi-passive because you need to run the business, but the bulk of the work has actually been done for you. So what you do is you hire people who are able to do the work right, and they are trained actually by the mother company, and the business is able to run. Better than buying a franchise is building a franchise yourself, but of course that is now a different conversation. That is not on the investment side of things. That is more on the business and enterprise side of things. You can build a franchise, you can build a business that people are willing to buy into, and open branches, franchises, so to speak, in your name. Because what happens in that case is at that point you are not running it day to day, but you are able to make money off it. So those are the classes I thought of talking about today. And as I come to a close, I want to mention just a few things before you invest, because I know probably having shared this, somebody is saying I need to make that move. and make it quickly. So, but before you invest, a number of things you need to do. One, do your due diligence. Do not invest in something you have not fully understood. The fastest way to lose your money is to invest it somewhere because you have seen other people doing it. Seek to understand, seek to know the intricacies, the nitty-gritties of the industry that you want to go into. That way you will be safe. Number two, seek professional advice. You want to invest in stocks, seek advice from somebody whose day-to-day job is to deal in stocks. You want to invest in real estate through REITs or directly, seek somebody who is in that field and get to understand how do they do this, so that you're not sinking your funds, your hard-earned money, into places that are wrong. Number three, and this is very important, check your emotions. There are two emotions that are critical when it comes to investment. One is greed. Greed is where you forget logic because something is doing well in the moment. So you throw all caution to the wind and go after it without thinking about the downside. That's one thing that happens when a company or a business or an investment is doing very well. You will see many people, when something comes up and it is doing very well, they all want to run there. They have not understood what is happening. They have not grasped what is going on, but they all jump into it because it's the current fad. And because they have seen a few people go in and make money, they think that everyone who goes in will make money. And that is how they end up losing. The other side of the coin is fear. Some people have so much fear that they will not dare to do anything. So they will be holding so tightly onto their money that they cannot take advantage of opportunities. So you need to manage both greed and fear in equal measure if you're going to be a successful investor. Then the next thing I say is beware of shiny object syndrome. What is shiny object syndrome? The latest thing in town. So everybody is investing in crypto. So I also want to invest in crypto. Nothing wrong with investing in crypto. There are people who are making very good money with crypto. But do you understand what is going on behind the scenes? Do you understand how it works? Or are you just jumping onto a bandwagon because everyone else is on that bandwagon? That's the question that you need to ask yourself. Shiny objects look good in the moment, but in the long run, you will burn your fingers. So ask yourself before you jump into anything. Have I understood it? Do I have what it takes to succeed in this kind of investment? Or am I simply doing it because it is the thing that everyone is doing? If you have to invest in a shiny object, please invest money that you are willing to lose. Yeah, your portfolio needs to have a portion of money that you are willing to lose. You are willing to gamble. Shiny objects are for gambling because it might work and it might not work. So if it works, good for you. If it doesn't work, well, a good portion of your investment is in secure places. So there is no loss for you, or there is little loss for you. Next, know yourself. Know yourself, very critical. Understand your risk appetite. If you know that you're a person who is afraid of losing your money, please stick to investments that have security, fixed income instruments, the bonds, the treasury bills and things of that nature. Stick to those and be content. Low risk, low return. If you are moderate, go for where here it can go either way. If you are high risk, do it. So understand yourself so that your emotional health does not suffer when you wake up one day and your investment is in the doldrums, like Mumia's Sugar. I don't know why I'm referring to Mumia's Sugar a lot, but yeah. And you also don't get crazy when it goes as high as Safaricom has done over the years. So know your risk appetite and approach your investment journey with that understanding in mind. Then think long term. Think long term. This idea of gambling or speculating will not take you very far. You will lose money. The only people that will make money off you are the agents and the the brokers and all that. Because you see what happened, there is nothing that a broker loves more than somebody whose mind is undecided. They buy and sell night and day. Because you see, every time you buy, he makes money. Every time you sell, he makes money. So if you are not ready to think long term, you're going to lose a lot of money doing these transactions time and time again. So when it comes to investment, think long term. You'd rather take some little time to make a decision, but when you make a decision you can stick with. Warren Buffett says, if you can't think of owning a stock for 10 years, don't think about owning it even for 10 minutes. So that long-term perspective is critical. So as I come to a close, what are some of the things you can do? One is part of why I did this is we have a class on personal finance and a coaching program. You can actually join one of our classes and be able to go deeper into all aspects of personal finance. Today I just picked a few things on investment, just to give you a glimpse into what we discuss in details in those classes. Or you can sign up for coaching. So feel free to get in touch with me. I'll be giving my number at the end of the session. Number 2, pick an asset class to start with. That is, if you've never invested before, pick an asset class in what we have talked about to start with, or to diversify into. Maybe you're already into some investment. You can diversify into another area. Maybe you've had something that you didn't know before, or maybe you've had something that you have known but you have not thought about it very deeply. You can look at that. Thirdly, you can also book a call with me if you are looking for a personal pension plan. I can help you to handle that for your own retirement planning. And I also have an interesting plan at Jubilee Insurance. For those of you who know me, I have a relationship with Jubilee Insurance. I have an investment plan called the Gold Plan. If you want to know more about it, please make a point of booking a call with me. So if you don't have my number, reach me on 0725 832 477. 0725 832 477. So thank you so much for listening to me tonight.